all day yesterday.
About 25 seconds away from the opening bell in New York City this morning. Good morning. On the NASDAQ, heading for a third straight week of losses on the NASDAQ 100 this morning. Down again by just 0.05%. Just about holding in there given what's happening in the bond market. Equity futures on the S&P down about a third of 1%. There's the opening bell. Let's take a look at that bond market. Your 10-year yield looks like this, up 2 basis points to 292.78. Your 2-year yield up a whole lot more. The curve this morning is flatter. The euro a little weaker. Euro dollar down to 108.26, going into the second round of the French runoff elections and all that good stuff on Sunday. Crude 102.14. We're negative there, 1.6%. Down by about $1.64. With some moves at the opening bell, let's get to Taylor Riggs. Hey, Taylor.
John, it's been far too long since we discussed Twitter, so I'm going to mention Twitter and Elon Musk again just to make your day at 9:30 in the morning. But take a look at the shares, of course, because Musk coming out and saying that he has secured about $46.5 billion. Portion of that, $25.5 in debt, $21 billion in equity. So maybe a little bit more than the $54.20 a share, depending on some analysis that you read. Take a look at Kimberly-Clark. You think about some of the big pricing powers that these companies have and the staples passing on to the consumers. Consumers don't mind. These organic sales are up 10% on higher prices. Schlumberger, I mentioned that earlier, a little bit to the downside. They're beating on the top margins and the bottom line. Energy continuing to have a good year, but not quite seeing that reflected in the share price. HCA Healthcare, just another one that we're looking at, down about 13% or so, saying that big labor cost inflation, John, pressuring the bottom line.
Taylor Riggs, thank you. And you mentioned the gap a little bit earlier, that at the open, getting hammered by 19%. A rough start to big tech with Netflix getting hammered in a much bigger way earlier this week. Next week, Apple, Alphabet, Microsoft, Amazon, all on deck. This is my favorite week of earnings right here, Katie. Not the banks, but this one.
Well, it certainly is when all of the heavyweights are coming. When you put 4 companies together, just Alphabet, Apple, Amazon, and Microsoft, they together represent about $8 trillion in market cap and 4 of the 5 largest weightings in the S&P 500. So when their results come, it matters in a big way to this market. Now, as you said, we're getting results from all of them next week and others as well, including PayPal, Qualcomm, Intel will be in there. So it's going to be very busy. Now, as you mentioned, Netflix didn't necessarily start things off on the best note. In fact, it was a pretty downbeat one with those subscriber losses and weak forecasts. The company also posting the slowest revenue growth on record for a quarterly number. And as for how revenue growth is shaping up for some of these other tech giants, Alphabet is expected to post a roughly 24% jump in sales, 18 for Microsoft, 8 for Meta, 7 and 5 for Amazon and Apple, respectively. For a lot of these companies, that would be the slowest revenue growth going back to 2020. So will they beat? Will they miss? Remains a question, but we do know whatever the outcome, it does have the power to move this market. As I mentioned, all of these companies are incredibly heavily weighted within this equity market. And when you put together the options implied post-earning price moves to the upper downside for those 4 as well as the other companies reporting next week, the market is pricing in nearly $1 trillion of market cap creation or destruction in just a 5-day period, John.
We could call it market crap as well. That works too.
It might work.
Katie Knights, thank you very much. This is what Michael Hartnett of Bank of America called it this morning. The meta curse. Words of extreme caution. A world of extreme inflation, his words. Rate shock just beginning. Secular flip from QE winners to QT winners. A rate shock equals tech trauma. Social media stocks back at spring 2018 levels. Fair to say that Michael Hartnett is still bearish on the rate story and what that means for the equity market. What does it mean for growth? This is an important conversation now with Mohamed Al-Arian, writing in the latest Project Syndicate piece the following. The IMF's significant downward revision to its 22 World Economic Outlook just 1 quarter into the calendar year has generated hand-wringing around the world. But no less important is the Dow forecast for 2023, which implies a broader crisis of prevailing growth models. Mohamed has been right over the last 12 months on inflation, where Chairman Powell and the rest of that central bank have been very wrong. Mohamed joins us right now. Mohamed, that's the inflation story, and we can touch on that in a moment. To what extent do you think we are missing the growth downgrades through the next 18 months?
We are, John, unfortunately. There's 3 big changes going on that we have recognized the impact on the inflation side, but we haven't recognized the impact on the growth side. 1 is changing globalization. 2 is limited policy flexibility. And 3 is the payback for many years of depending on artificial sources of growth. And when that unwinds, it doesn't just have an inflation component that we're talking a lot about, but it also has a medium-term growth component that we're going to start talking about as well.
So Mohammed, over the last month, you've talked about this binary choice between a hard landing or prolonged inflation. Is this another reason why you think the central bank might have to choose a lesser evil here and tolerate above target inflation for a much longer period of time?
John, it's gotten really complicated. I think now there's broad appreciation that a soft landing, that pathway is not very likely. We should hope for it. It's certainly the most desirable way to go. But because the Fed is so late and because the market keeps on running away from the Fed, it's less and less likely. So that is really unfortunate. Then you got to, like you said, make a decision about if you have to make a mistake, which one? I suspect the Fed will end up flip-flopping. I don't think they're going to opt for one or the other like most Wall Street analysts are trying to do. I think they'll end up flip-flopping. And that's not a good thing because that means we may end up with an inflation problem persisting and a growth problem persisting.
Put some more meat on that, Mohammed. What will lead to that flip-flop?
So already the Fed's being forced to get more hawkish. Every time it gets more hawkish, the market says, I want you to be even more hawkish. You've been talking about it this morning. Now suddenly 75 basis point hikes are being talked about when 4 weeks ago talking about 50 basis point hike was courageous. Yesterday, the break-evens went up. The implied market measure of inflation went up just after Chair Powell became even more hawkish. So what you're getting is the Fed isn't able to catch up to the market narrative. We've seen this in developing countries. It's not a good dynamic to be in. It typically results when you're very late as a policymaker, and we're seeing it play out, John.
Mohammed, you touched on something really important. You brought that up earlier in the week as well. As we've been talking about bigger and bigger rate hikes, break-evens have kept picking up. Now, I wonder, Mohammed, whether that's a factor of a conversation about getting to neutral quickly, which ultimately is irrelevant to what's going to happen further down the road. If you go from, let's say, 0 on interest rates of the Fed funds to 225 and you do that quicker than anticipated, but then you stop, do you think that's what this market's picking up on, Mohammed, that actually we have consensus at the Fed about getting to neutral, but we still have a divided Fed about what we do after that?
Yeah, putting it in terms of neutral is having a very sophisticated packaging to something that's really uncertain. I don't think anybody knows what neutral is. I really don't. It's a time variant concept. It has been influenced by all sorts of distortions that have been taking place. So I certainly don't know what neutral is, and I doubt that anybody can accurately say what neutral is. But it does speak to the other dynamic, which is having failed to ease its foot off the accelerator for so long, the Fed is going to be forced to slam on the brakes. As it slams on the brakes and jerks other things in the economy and in markets, it's going to then ease off the brakes. And that's what the market is saying. Now, if you want to put it in the language of we get to neutral and then we stop, that's fine. But I think fundamentally it's a different dynamic. It is the one of the stop-go element that tends to result when you are late in adjusting policies.
Mohammed, one thing that I've been guilty of and often guilty of is to look for fundamental explanations for price action. And this week may be a good example of that, where we've had another big move in the bond market, people associating it with something maybe Chairman Powell has said or with some economic data somewhere else. But over the last couple of months, I think what we've both witnessed, and you and I have talked about this together, is that we've had these big moves and often there isn't a catalyst for them. And Mohammed, I'd love for you to build on that for our audience today, just to explain what you think is happening within this bond market and whether it's actually connected to anything fundamental or any particular catalyst whatsoever.
So let me give you a factoid. Just before Chair Powell spoke yesterday, the 10-year yield in the US had traveled 30 basis points up and down in the last 3 days on no major news. That is liquidity. And what you're seeing is that the deepest market in the world is having some, at the edges, liquidity strains. And we're seeing these outsized moves in yields. Now, people who've been in market for a long time are saying, keep an eye on this. This is interesting. Why, John? Because right now we've only talked about interest rate risk. We haven't talked about liquidity risk. We haven't talked about credit risk. All the focus has been on interest rate risk. And a really open question is, at what point does interest rate risk spill over into liquidity risk and credit risk? And that's something that we should be talking about much more and analyzing deeply.
Mohammed, let's do that now. What do you think is fueling that?
So I think the market is obsessed with interest rate risk right now, but growth is weakening. It is weakening all around the world, in the US, in Europe, in China. At some point, we're going to start wondering about credit risk. And then remember that you have a whole marketplace that has been conditioned by what remains very loose financial conditions. Let's remember that. Financial conditions, while the delta has been towards tightening, the absolute level for the US is still very loose. If that changes, which it will if credit spreads move, if equity prices move more, and if rates stay where they are, if that changes, then you've got liquidity risk in play as well. So that's the sequence. You know, John, I didn't want to be right on inflation. I didn't want to be right on the Fed being late. I don't want to be right on interest rate risk becoming also credit and liquidity risk, because then we are in a much messier situation than we are today.
Are there reasons to believe that you will be right on that? And what are those reasons?
I think the reason basically to believe that is that you may get a policy mistake, an even bigger policy mistake. And that by itself would turn interest rate risk into also credit risk and liquidity risk. So that's the reason. If you think the Fed is going to make a policy mistake, and the market is starting to signal that. I go back to the break-evens. I go back to what's been happening to the front end every time they speak. That's what you have to keep an eye on. That's the key judgment that you have to make right now.
Can I ask a broad question then about market exposure, Mohammed? How you'd allocate to risk assets right now, how much risk you'd be taking, and as you think about maybe what you describe as the risk mitigation characteristics of treasuries, whether they are still a factor that you would want in a portfolio.
So you've heard me say for weeks and weeks, okay, that it's time to take chips off the table. And yes, cash is not that attractive with inflation at 8.5%, but a bond market that's down 10%, and NASDAQ that's down 15%, cash is not a bad short-term shelter. Now, the good news is that value is being restored. It's a painful process, but value is being restored. The bad news is we're coming from very, very distorted prices levels. So it's still going to take some time for full restoration of value. So I'm still cautious here. You know, am I attracted in the 2-year at 276? Yeah, that's much better than 1%. But I'm not sure that the adjustment to the changed liquidity paradigm is over yet. So that's why I'm still cautious, and I have been, as you know, for a number of weeks. And I've said it on your show, John.
You have. Mohammed, you've been a good friend of this program. We appreciate your time this morning. I know it's super valuable to the whole audience. Mohammed Al-Erian there of Queen's College, Cambridge. He doesn't like to boast about it, but he has been right, and this Fed has been dead wrong, and that has been captured by the front page of The Economist this week, that's for sure. You'll see the headline on that. The Fed that failed, how inflation humbled America's central bank. Quite a front cover from The Economist this week going into the weekend. I know a lot of you are thinking maybe it might be time to lean the other way. Maybe. I'll allow you to make that decision for yourself. Coming up, investors looking for places to hide amid surging inflation.
Do I want to sit on the sidelines and just hold cash? With inflation, I think that's actually risky. So owning hard assets and things you have high conviction in makes sense.
We'll get a call on big tech and tech earnings next week with Brian Levitt of Invesco.
One of the things for individual investors to think about is in a volatile market like this, do I want to sit on the sidelines and just hold cash? With inflation, I think that's actually risky. So owning hard assets and things you have high conviction in makes sense. And what you're seeing is an expression of that high conviction.
Where do you go with inflation at 8.5%? That was the brilliant John Gray of Blackstone. Looking at this equity market, we look to the data now with some breaking news. Here's Taylor Riggs.
John, the composite PMI, of course, is out, and it does not look good. You have it rolling over to about a 55.1 on the S&P Global Composite Index. That's down from survey expectations of 57.9, and indeed down from the previous month of about a 57.7. Why? Because the services PMI is also rolling over in a decent way, down to about a 54.7, below expectations and down from the previous month of about 58. Manufacturing a little bit better, 59.7 versus estimates of about a 58, and indeed a little bit higher than the previous month of 58.8. But overall, this looks like a little bit of a weaker read. From the services side, I think what I can see, the second lowest number that we've had since about June of 2020. Of course, still in that expansion territory, though.
Taylor, great work as always. And Taylor, thank you for everything this week, for stepping in and stepping up. Thank you very much. Taylor Riggs there on the data. That's the last big data point for us this week. Looking ahead to earnings next week with big tech on deck. Apple, Alphabet, Microsoft, Amazon, all coming out with earnings. Joining us now, I'm pleased to say, Invesco's Brian Levitt. Brian, straight to you, sir, and straight to your outlook for some of these big names. What are you looking for?
So I think what investors are going to realize is that these are not there's more diversification amongst these names than we may have thought in the past. People used to paint big tech with one broad brush, and of course you're seeing a differentiation with that in the market. So for a company like Microsoft, the cloud computing business is strong. You're likely to continue to see strong earnings. For companies like Google or Meta or Alphabet or Meta, where that are being supported more by ad sales, you're likely to see slower revenue growth or earnings growth than a company like a Microsoft. So it's going to be more differentiated than what it had been in the past. But I do think what investors should be mindful of is, they tend to want to sell tech that they consider to be longer duration assets. The reality is a lot of these companies, like an Apple in particular, sitting on a lot of cash, likely to buy back stock. So when I think of where we are in this market, it's more about quality and cash flow generation rather than painting a sector with one broad brush.
Brian, is that reflected in the price action that's been developing over the last month or so?
Yeah, you've certainly seen some of these, if you go back to the old FANG, you've certainly seen the market take out pretty significantly companies like Facebook or Netflix that have just not met the expectations of the market. And when a big company like that at lofty valuations underperforms, the market is hitting those companies hard. Whereas, other parts of the market, you have not seen that type of, other parts of the tech sector, you've not seen that type of hit. A company like Apple, which is, again, sitting on a lot of cash. Yeah, sales are going to slow for the iPhone and the Mac. They have been. Supply chain challenges still persist with zero COVID. But certainly a company sitting on a lot of cash and viewed by investors as very high quality.
You mentioned Meta a few times. Facebook this week is down by almost 10%. On the year, it's down by 44% almost. It's been terrible for them year to date. Difficult over the last year. You mentioned Apple too. You didn't mention China in a big way. So can we talk about that, Brian? I'm actually really looking forward to the Apple earnings because I want a decent read on what's happening in China. How do you think that's shaping the story for them?
Yeah, the China story is a challenging one right now because of the zero COVID policy, because of hundreds of millions still under some form of lockdown, which creates further supply chain challenges. We've already seen slowing growth for hardware. For Apple, you've seen it in the iPhones and the Mac, not to dangerous levels, but a slowdown, as you may suspect, following a period in which consumers spent a lot of money on a lot of these types of products. The question, I think, in Apple is really to look at what's going on in services. Concerns with what you've seen with Netflix as subscriptions have slowed or people have even left. You want to look to see within services how Apple is faring.
Brian, that's the earnings story for the individual names. Let's just get to the bond market briefly. Can you walk me through how you think the front end of the yield curve is connected to what happens with some of these growth names? Because I get a lot of people to come on the show and say it's a big story, it's a big issue, there's a direct link between the pain they're going through, others that push back. Where do you sit in that debate?
Yeah, I would say that, you'd want to think about where long rates ultimately settle. I mean, the move up in short rates and a flattening of the yield curve, tighter financial conditions, and what we're starting to see, as Taylor represented, some slowdown in the economy, should tend to favor structurally advantaged growth businesses, companies that can still generate growth in a weaker economic environment. The challenge that we've seen as rates have shifted up across the yield curve and continue to move higher on the 10-year is a valuation readjustment. And in the market's eyes, some of these names were, particularly like a Meta or like a Netflix, are trading at very elevated valuations and have now been brought down meaningfully. So, I would say that, as conditions continue to tighten and the economy slows, I think investors are going to be back looking for high quality, and some of those are going to be the big tech winners, the big tech names.
Brian, great to catch up, buddy. As always, Brian Levitt there of Invesco, looking at this equity market into earnings next week. Two things I want to look at outside of the equity market, which is struggling a little bit. At the front end, yields are higher by 6 or 7 basis points on a 2-year to, let's call it, 275. And sterling, we were recovering briefly for the best part of 10 minutes. Some renewed weakness again. Cable 128.79. Earlier on this morning, consumer confidence in the UK, the lowest since 2008. Retail sales worse than expected. And a Bank of England that's now staring down the barrel of hiking into weakness. Coming up, your trading diary, the guide into the weekend and out the other side into next week. This is Bloomberg. 26 minutes into the session, your equity market is down by about 0.7%. Down on the day for a third straight day and down on the week for a third straight week. That's the price action. Here is your trading diary. Treasury Secretary Janet Yellen coming up at 11:45 Eastern Time. Speaking of David Westin, do not miss that. Secretary Blinken, the Ukrainian Prime Minister, alongside each other, 2 p.m. President Biden speaking later this afternoon. Plus, France's runoff presidential election this weekend. And finally, into next week with earnings from Apple, Amazon, and let's just keep calling it Facebook and Alphabet, all on deck from New York. Thanks for choosing Bloomberg TV. This was the countdown to the open. Enjoy your weekend. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, April 22nd. Here are the top market stories we are following for you at this hour. Getting aggressive. Fed Chair Powell says 50 basis points is on the table for May. The market now pricing in 4 consecutive hikes of that size. But Nomura sees 75 basis point moves in both June and July. Short end surge. The 2-year yield is at the highest since December of 2018. The dollar at its highest since June 2020. And equities are struggling to end the week. And sights on the south. A Russian general says the Kremlin is seeking control over the entire south of Ukraine. We'll discuss the West's next moves in a potential energy embargo with Spanish Finance Minister Nadia Calviño this hour. From New York, I'm Caitlin Lyons with my co-host in London, Anna Edwards. Alex Steele and Guy Johnson are off today. Welcome to Bloomberg Markets. Anna, it's Friday and a lot has changed since Monday.
Yeah, absolutely. It's been an incredible week, hasn't it, Kaylee? And actually on both sides of the Atlantic, because often we talk, maybe it's a week where the Fed dominates or the ECB. But this week we've had commentary on both sides that seemed increasingly hawkish, and the market's waking up to that increasing level of hawkishness, it would appear. I was reading some research by Bank of America a little bit earlier on, talking about how 75 might be the new 25 when it comes to setting our